Financial markets are growing ever more innovative, ever faster, ever more interconnected, ever more productive. And at the same time, federal financial regulation is becoming itself ever more complicated, but also more and more politically salient, sometimes even politically controversial. And so we thought we'd have some conversations about that today, both on some specific issues and regulatory questions, and also just about the big picture question of the state of financial regulation. Again, if this is the 20th anniversary of JLEP, it seems like the right time to take a look back and also to take a look 20 years forward. That's what the opening panel is going to focus on above all, the big picture. What is the future of financial regulation? We're very, very lucky to be joined by this group of speakers, and also lucky to be joined by our moderator today, Professor Paolo Saguato. He's a great friend of the Gray Center and a great friend of mine. I'm very, very glad he's here to moderate the panel. He's an associate professor at the Antonin Scalia Law School. He writes on banking regulation, on systemic risk regulation, and more. And he's also leading the Scalia Law School's new program, the Financial Markets Program, which is going to help students, faculty, and practitioners think harder and think together about markets, their regulation, and how to educate students on these things. So maybe Paolo will educate us a little bit today too. I'll turn it over to you.
So I'm going to briefly introduce the panelists, but then you can find more information in the booklet that was circulated about the conference. So on my far right, John Cochrane has the roles. Mary and Jack Anderson, Senior Fellow at Hoover Institution at Stanford University. John recently published a book titled The Fiscal Theory of the Price Level. No better timing to publish a book about inflation. John has written extensively on monetary policy, inflation, asset markets, and financial regulation, among other things. Next to John is Kathryn Judge. Kate is the Harvey Goldschmidt Professor of Law and Vice Dean for Intellectual Life at Columbia Law School. Kate also recently published a book titled Direct, The Rise of Middleman Economy and the Power of Going to the Source, about the intermedification of the economy. I think I just created that word. A research focused on banking, financial innovation, financial crisis, and regulatory architecture. Next to Kate is Jonathan Macey, the Sam Harris Professor of Corporate Law, Corporate Finance, and Securities Law at Yale Law School. John has written extensively on corporate governance, corporate finance, securities regulation, and financial regulation. He holds a PhD honoris causa from the Stockholm School of Economics, and also he was my banking law professor and a very fluent Italian speaker. Last but not least is my colleague Todd Zywicki, that does his thought about the future of financial regulation. I think by the authority granted to me by Adam, I declare Italian as the official language of the panel. It's Italian-American Heritage Man. So, John, il podio è tuo, per favore, parlaci della regolamentazione dei mercati finanziari.
Va bene, se deve essere in italiano, deve essere in italiano.
Perfetto, John. Benissimo.
Non c'è nessun problema.
Benissimo. Majority of the panelists speak Italian, so let's do this.
I think I'm going to violate that rule. As much fun as it would be. So we're supposed to talk about the future of financial regulation. That's too depressing, so I'm going to talk about what the future should be rather than what it is most likely to be. And I'll advertise. We're all advertising stuff. I have an essay towards our run-free financial system, which contains some of my ideas here. Plus, of course, we're writing a paper, which you all should read when time is done. In 2008, we had a little financial crisis, as you may remember. Bailouts right and left, but at least the people in charge had the decency to recognize that something was wrong with this, and to recognize the moral hazard that the bailouts entailed, and said, we'll fix it, and they passed the Dodd-Frank Act. Never again. 15 years later comes the second great once-in-a-century crisis, and we just did it all again. And that architecture has basically failed. To be specific, what happened? There was a pandemic, but also, starting March 2020, the Fed bailed out the Treasury markets with some technical issues that had been pointed out for years and nobody got around to fixing. There was a run on money markets. Money market funds are about the easiest things to fix. Again, 15 years, everybody understood it, no one got around to fixing it. Direct lending to state and local governments. The Pandemic Protection Act was in many ways a financial bailout because give companies money and the companies can pay their banks back. My favorite, the Mario Draghi worthy whatever it takes on corporate bond prices announced by the Fed. Apparently, mark-to-market losses on corporate bonds are something nobody should be allowed to ever suffer again, and so forth. Then we had the Silicon Valley Bank failure and First Republic Bank failure. These are instructive, I think. How did these banks fail? They took unsecured deposits and put them into long-term treasuries. No toxic derivatives, no crazy financial engineering. This is stuff we've understood at least since the 1700s exactly how that sort of run figures out. Yet, this massive regulatory architecture was unable to see that elephant in the room coming. I think that's important to recognize. What are the limits of this regulatory architecture? You can't see basic interest rate risk coupled with unsecured deposits and do something about it. Heavens, think of all the fancy stuff they're trying to do. I mean, this crew is going to go out and find climate risk to the financial system, whatever it means. I think the UBS failure was also instructive. Remember all the wonders of how we're going to stop big bank bailouts, because we're going to have resolution authority, orderly liquidation, the equity gets wiped out, no more big bailouts. Nope, sorry, can't bother with that. Put to the test, that whole project was revealed to be empty. The one thing we didn't do is bail out the big banks again, but I think we are very clearly in the regime. The big banks are too big to fail, period. So much for the end of too big to fail. Now, what's wrong with a river of public bailout every 10 years when it comes along? Well, what's wrong, first of all, is the moral hazard of it. Keep not levering up is crazy, and keeping some cash around to buy on the dips is pointless if you're always going to be front run by the Fed. So the moral hazard, and of course, eventually we're going to run out of money. Even Uncle Sam is going to run out of money. If, let's say, China invades Taiwan, we're going to have the mother of all financial crises. This last time, $5 trillion turned out to be too much. The Fed, the government tried to borrow $5 trillion, handed it around, and got inflation. We are quite plausibly at the fiscal limit. There comes a moment when it's too big, even for Uncle Sam to bail out, and then heaven help us. Because the worst thing is when you build a big firehouse and then the firehouse burns down. So what are we going to do about it? I think we have to recognize the basic architecture of this system is broke. The basic architecture is financial institutions can, it's not in their assets. Financial institutions' assets are unbelievably safe. I mean, imagine the puzzle. Let's look at like Tesla's cash flow prospects versus the assets of a typical big bank. One is, spaceships to Mars and electric cars. The other is a widely diversified portfolio of fixed income assets. Where are all the regulators looking at risk? Over here. That's crazy. These are the safest assets on the planet. Why? Because they're financed by high leverage into run-prone liabilities that cause crises. The problem is the liabilities, not the assets. So the answer is fairly simple and obvious once you state that. The problem is liabilities, and we've had this answer sitting around pretty much forever. And I'll summarize the answer as equity-financed banking and narrow deposit taking. I don't use the word narrow banking for a good reason, because I hate those words. You're going to have all the banking you want, all the lending you want. You're just going to finance it by common equity and long-term debt. You can issue all the short-term liabilities you want. You're just going to back those 100% by reserves or similar short-term government liabilities. Now, why is this a good answer? If we do that, before you start objecting, if we do that, we can end private sector financial crises forever. Now, of course, some of this is linguistic. We have to answer the question, what constitutes a crisis? What is systemic risk? I'm an economist, and I will notice that most of the big words used here are fairly meaningless, or at least undefined. We have to understand a systemic risk, a crisis, is only that a systemic run on short-term liabilities. It is not the possibility that somebody somewhere might lose some money on a mark-to-market basis. That doesn't constitute a financial crisis needing regulation. So we can stop systemic runs forever. How? If a equity-financed institution loses money on the assets, what happens on the liability side is your stock goes down, You lost some money, you go home, you have a whiskey, you yell at the dog. There's not much you can do about it. If you hold short-term debt or another run-prone liabilities, what you can do is get your money, try to get your money out before everybody else and bring it down. So floating value assets eliminate financial crises. Before you start saying, oh, but that's too costly, oh, but I might pay 10 basis points on my mortgage, just think about the benefit. And private sector financial crises and all the moral hazard and taxpayer liability involved in the bailouts forever. That's a pretty big benefit. And this is something we've understood since the 1930s. I'm sure you're full of objections. All the objections have been answered. Yes, you'll be able to borrow lots and lots of money. Yes, there will be plenty of places for you to put deposits in. We're sort of lucky in having, out to $30 trillion of federal debt. Those can back an enormous amount of 100% backed assets. And it's also practical. Now, you economists come in the room and lawyers go, oh, you guys with your airy-fairy big ideas to change things. We do not have to reform the current dinosaurs. You just have to let it happen. You just have to get out of the way. Allow equity-financed financial institutions to emerge, but recognize when you start one of those, you should get a gold star for non-systemic risk. So if you allow financial institutions to emerge that are financed in ways that don't have run-prone liabilities, they don't need any more regulation than, say, Tesla. I mean, regulation against fraud and so forth. But they don't need asset risk regulation. Why? Because their liabilities do not present a systemic risk. I think if you allow people to innovate in ways that do not require extensive regulation, they will come. And you can also, if you want to operate as a big bank with all the mountains and mountains of rules and the compliance department, all the rest of it, go for it. But if you want to start something else, similarly on the deposit side, we're actually getting closer to there than you think. A money market fund with enhanced transactions facility is a narrow bank. The Fed could just stop its legal war against narrow banks. We're talking about central bank digital currency. That, if used by financial intermediaries, that's a narrow bank as well. So stop the war against narrow bank, allow the equity financed financial institutions to emerge, keep the current system around, and it will simply wither. So you don't need any vast project of trying to reform, Citi and Bank of America. Good luck with that. So it's practical. It ends financial crises forever. The basic architecture of allow lots of extremely high leverage, run-prone liabilities, but count on the regulators to spot the risks coming. That basic architecture has just failed so badly that I don't think we can ignore that fact and just keep layering it on. Thank you.
Thanks, John.
All right. Let me start by just thanking Adam for putting this together and for inviting us to look 20 years out. It's not something we normally do. I was thinking about this. I was at the PIMCO Economic Secular Forum in the spring, and there it's interesting because you're just looking 5 years out. And for people who are looking for investable actions, 5 years is a really long time frame. But I think there's an incredible value in trying to actually look 2 decades ahead, recognize we're going to have incredible humility, but just to take a moment to think, well, what might happen over those few decades? And so I really tried to take that to heart. And I started, as you said, by looking back, right? And so if I look at the last 15 years, stability has dominated the conversation, and with very, very good reason. I think 2008, we recognized there were incredible costs. We really wanted to figure out how to build a more resilient system. And it's very easy to look at what's happened in the last couple of years, to look at what happened in the spring, and think, well, stability really needs to continue to dominate the conversation. It's also a safe place to be. It's really nice to be able to have both animating and limiting principles for government intervention. And so trying to understand where the externalities are, where the market failures are, and then divine mechanisms to address those is a really kind of elegant and safe place to be. It's where I've spent the last decade and a half. For the most part. And my prediction going forward is that if financial regulation is going to succeed, or if we're actually going to have kind of the healthy debates that make us relevant, we're actually going to have to move out of those spaces. And it's a little bit uncomfortable for me to say that because we don't yet have the animating and limiting principles. And so I started down this road by looking at, well, where are we already doing this? Because we're already doing it a lot and a lot more than we want to concede. So, for example, the last couple of years, I've been working with Anil Kashyap at Chicago Booth to look at anti-money laundering laws, the infrastructure, and how it's now being used as well for sanctions purposes. There's a lot of times that we've both regretted walking down this path together. We got to know each other actually because we both care about financial stability, and we're looking for another area. But what you realize is because it's not elegant, nobody looks at it. So in contrast to financial stability, where there's been an incredibly healthy, broad, interdisciplinary debate with a bunch of academics, a bunch of policy folks, a bunch of industry folks, and we actually understand the trade-offs, there's discussions over what that actually means, there's at least been that conversation. There is no equivalent at all when it comes to AML. There's a little conversation on the edges with compliance. Nonetheless, that doesn't mean we're not doing it. It means we're doing it in a way that's incredibly costly and incredibly ineffective. So cost estimates vary. LexisNexis comes out with annual surveys. Their estimates are last year worldwide cost a little bit over $220 billion in compliance costs related to AML and sanctions infrastructure, and it's been going up steadily at an incredible rate. In terms of efficacy, really hard to measure. There's very few kind of actual measurements out there, but there have been some attempts to say, well, of the illicit flows, how much are we actually capturing? Those estimates vary between 0.1% and the highest being at 1.1%. The most commonly cited factor is about 0.2%. And so clearly, if you look at the surveys of law enforcement, they are really reliant on this data. If we think about what happened when Russia invaded Ukraine, or even earlier with Crimea, we really are going from sanctions against countries to trying to think about elites within those countries. And I think we're thinking about that in areas beyond Russia. So there's reasons to think going forward in the geopolitical environment we're going to be in, we really need this infrastructure to work well. But right now, we don't have a good theory for what we're trying to do or how we're trying to do it. And it's an area where I think you actually need public-private cooperation. So right now it's being done kind of through this compliance framework, but the challenge with a compliance framework is it assumes a baseline, and you're just trying to get people to not deviate too far below that baseline. But as a practical matter, the technology, the data standardization that you would actually want to do this really well requires not just a compliance where you can come in with enforcement and fines when people do it really badly, but actually what is the type of public-private cooperative relationships we might want to imagine how we could actually do this significantly better than we are because we're doing such a bad job with it. And it's not just in terms of the cost relative to the efficacy, but there's also huge collateral consequences. So I think given how bad we're doing, we could do a better job without further infringing on civil interests like privacy, or actually dealing with some of the economic access issues. But those issues also come into play. I mean, there's fundamental trade-offs with respect to how we design the system over how do you actually go about protecting privacy, and how do we actually create a situation where people have access to financial services, things like cross-border flows, when you put significant impediments into place, that actually really changes the nature of business and remittances that can otherwise happen. So what I'd like to see is just a more robust, much broader debate over how we think about actually building the system. Another area, historically, is the U.S. has played a huge role actually shaping the type of credit available and type of financial institutions. What that should actually look like, it's hard to know. Again, I don't have animating or limiting principles. I certainly don't want to go to unit banking. But right now, because we don't have those principles, there's very little robust discussion, again, of what we're already doing in these domains. So my pet interest here has been the federal home loan banks. I've never set out to study the federal home loan banks, but I've tended to look at, where are the markets doing something that's very different than what we think would happen? And then the federal home loan banks just show up. So it started in 2007, 2008. I was where did banks actually go for liquidity? Because the Fed doesn't look like it was actually doing that much. The answer was the federal home loan banks. Of course, this happened again more recently with SVB. They had no borrowings outstanding at the end of 2022. By the time they failed, they were the biggest borrower from the Federal Home Loan Bank of San Francisco. The same thing had happened way back in the S&L crisis, right? So this is a chronic problem with the Federal Home Loan Banks because they have become a lender of second to last resort, but without any of the incentives and without any of the accountability that accompanies the Fed playing that role. And the Fed's perfectly happy with this in a lot of ways because it lets them off the hook of making difficult decisions. And it's a practical matter. When you're providing liquidity to distressed institutions, you're going to have to make difficult decisions that I think the Federal Home Loan Banks are incredibly poorly designed to make. So my first instinct is this whole thing is just a mess. We ought to get rid of it, particularly when we look more broadly, that really as a practical matter, the great majority of the benefits. I mean, they are able to operate largely because they have a whole variety of statutory protections that allow them to stand in front of the FDIC and all of the other depositors when a bank fails. and they're able to raise money incredibly cheaply because of a government backstop that actually gets embedded into law in a whole variety of areas where we assume that these can be treated, the debt that they issue can be treated like government securities. But then I decided more recently to try to look a little more into the history. And it is a really interesting history because if you look at the first few decades, I decided, to my surprise, that there actually was a place for them when they first started out. So they were created in 1932, actually under Hoover, so a little bit before the rest of the New Deal. At that point, your typical mortgage was less than 5 years. And it was a balloon mortgage. And they said, look, and of course, mortgages were provided by thrifts, which were building associations, savings and loan associations. These were very small, community-oriented institutions that were inherently fragile, and they had no access to the Fed. And so at the time, they came in and they said, look, let's create an entity that effectively creates a backbone that makes these smaller institutions more viable. It played also eventually an important role, not only kind of raising money in the capital markets and providing it to those banks, but also redistributing liquidity around those small institutions. So when they had excess deposits, they could use the Federal Home Loan Banks to move that to other thrifts. And so for the first few decades, I would say it actually played a relatively helpful role in helping to promote some credit creation and enhance the viability of small institutions in an environment with incredible informational frictions and where there was very significant liquidity constraints. 1980s, I'd say at the last point, is probably when all of that changed. We had a huge change, first of all, over time in terms of housing policy. So now the government does so much. The notion that Federal Home Loan Banks can have a marginal impact there, I think, has largely been muted. Banks and thrifts stopped having a meaningful difference between them. Thrifts were given access to the Fed. More recently, we've actually seen non-bank institutions actually playing the key role providing mortgages, and they've done it all with no access to the Federal Home Loan Banks. And really, they became kind of a piggyback for Congress because they operate not completely, but largely off balance sheet. So the way that they now help out housing is by having a small portion of their earnings go to affordable home loan projects. So we have all kinds of, and this is not the only entity that's like this, but we have all kinds of entities that are like this, and right now we're just not talking about them, or we're saying we should get rid of them, but there's actually no will to do that. And so trying to figure out, well, maybe there is a role that they might be able to play with very small institutions in genuinely constrained areas of credit. Can we have a much, much, much smaller system that is actually something close, more tethered to what it originally did, could help to address some of the challenges we have in terms of local economic activity and also result in far fewer distortions. So the overarching idea, which I'm still developing, and again, I'm not going to go far with this because I'm not going to do well as an academic trying to look 20 years ahead, is there's a lot of different domains right now with financial regulation where you actually have kind of these public-private ecosystems. They are absolutely pervasive. And right now, nobody politically is talking about it. Everybody, I think there's a tendency on the left to think about how can we have the government do more through various types of public options. There is a tendency on the right to still want to have the government do less. And neither side is grappling with the fact that there's public-private ecosystems that are pervasive, and we don't have a good theory over what we want them to be doing or how. And as a result, we're allowing kind of these messes to continue without adequate conversation.
Great. So in thinking about where we're going to be in 20 years or from now, I tried to begin by kind of focusing on what I think it is that we know and trying maybe a little bit to build on that. And one of the puzzles, and this is in this way my talk I think dovetails pretty nicely with what Kathryn and John were saying, is that it is very easy and accurate and powerful, particularly after the collapse of Silicon Valley Bank, which John accurately characterizes really if I can, at least the implication for me, John, is a incredible condemnation of the ability of regulators to regulate. That I've spent a lot of time since the collapse of Silicon Valley Bank looking at its financial statements and balance sheets. And you can go back 6 months before the collapse and look at their filings, their public filings and their balance sheet. And without even looking at the footnotes, the balance sheet reveals that Silicon Valley Bank was insolvent. That is, you simply look at the notes, and you look at the record of the value of their hold-to-maturity securities, and you subtract from the value listed on the balance sheet what the market value is, which is again not in the footnotes in the text of the balance sheet, and their assets are less than their liabilities. It's kind of an amazing condemnation. So what I'm left with is the following puzzle, and this is what I try to kind of wrestle with in my paper for this conference, which is, if sort of the question is, if things are so horrible with a regulatory system, and I think they are, don't misunderstand me, then why are we kind of so rich? Why is the economy on many methods of calculation doing so well? Stock market returns, corporate profits, things like that. And of course, there are two possibilities for this, right? Which is the first, which is definitely a realistic possibility, which is we've kind of jumped off a 100-story building and we're floating down to the ground and or careening toward the ground, and we're at like the 38th floor, and somebody says, "How are you doing?" I say, "Great, everything's fine." That's a possibility. We're just waiting, and we'll be smushed. Or alternatively, and this is the take on this that I kind of prefer, obviously, is there's maybe something else going on in this picture, right? And so, and basically, the story that I think is right and will help us to sort of predict the future is that kind of as bad as the government sector is at regulating, that the private sector is even better at innovating away from some of the most negative consequences of regulation. And the particular facet of this that I focus on in my paper is the kind of political mess in Washington, and been intrigued by a number of political scientists and people at the Brookings Institution, a political science professor at Princeton named Lena Mosley, who in a bunch of papers recently, basically saying that, and in addition to that, the fairly recent Fitch's downgrade of U.S. Debt, and where the political scientists are saying, big threats to democracy from the political chaos in the United States, the election denials, and that institutional investors have to respond to threats to democratic institutions, and that Fitch's downgrade, they said there's been a steady deterioration in standards of governance over the United States, including on fiscal and debt and debt matters. So basically, looking at this, I try to look at this empirically a little bit, and I say, well, what happened, around January 6th with the insurrection in the Capitol, and basically looking at things like stock market performance, the volatility index during the course of the day, initial public offering, foreign direct investment, GDP growth over that year, 2021, that the economic and capital markets in the United States exhibit remarkable stability in the face of the regulatory failures and political disruptions. And basically, I attribute this to two causes. One is that politicians happily still on both the right and the left internalize the cost of screwing up the economy. They're worried about getting thrown out of office. People are always looking at how are we doing on unemployment, how's the stock market doing, and then we have basically kind of, I don't know if I'd call them but counter-democratic institutions, like the corporate law in the United States is outside the hands of the federal government. It's in the hands of basically the state of Delaware. I view as a good thing. You have the Fed, which is fairly insulated from politics, and so we have these. We have, in essence, we have a situation where we live in simultaneously, and with this we live simultaneously in two worlds. One is the economic world, the world of markets, which are functioning well, and then the world of government and politics. And I think they increasingly become disjointed, and I see that disjuncture to continue over the next 20 years, and I view that as a good thing. Thank you.
All right. Well, thanks. It's great to be here, and also this is my first event for the Gray Center since Boyden's passing, and so I just wanted to express my admiration for the man and just say what an honor it is to be here with this distinguished panel. So I guess the idea is we're looking forward 20 years. I spent a year, as Paolo mentioned, as the chair of the CFPB task force on consumer financial law. We wrote an 800-page report with 101 recommendations. So I'm going to read that to you today on the future of financial. No. So this will be the Cliff Notes version of that if you want more. But I think that what this does is my paper is entitled "Looking Forward by Looking Back." And the idea here is interestingly captured in a book I wrote, co-authored a few years ago, Consumer Credit in the American Economy. And the great Vernon Smith, the Nobel laureate, actually wrote a blurb for the cover of the book. And Vernon didn't really know much about consumer finance, but he's a genius. He started reading the book and kind of got taken into it. And the blurb he said was that consumer finance and consumer financial regulation reveals an emergent order of behavioral and parallel institutional rules, evolution of an emergent order of behavioral and parallel institutional rules with no identifiable leader, right? And that's sort of the idea that I'm going to say here in predicting the future and what the future of consumer financial regulation should look like is what we've seen over time is the reality is that we see technological changes that dramatically impact the delivery of consumer financial products. We see changes of consumer preferences that match up with that and show why consumers want to use consumer finance as well as various products. And then what we see over and over again is a combination of entrenched special interest who try to block these evolutions, and really elite preferences of people who think other people shouldn't be allowed to have a consumer credit that end up creating this dysfunction where you get these old stupid rules that the regulators try to impose on people. People sort of work around it. It ends up being counterproductive, and essentially finally the tension snaps and we're forced into a new regulatory regime. And so we can kind of see this in three cycles. I call it the pre-modern, the modern, and the future that we'll talk about on sort of 50-year cycles. So let's go back to the beginning. Understanding consumer finance, even Adam Smith, of all people, didn't understand consumer finance. Adam Smith favored usury regulations for consumers because he had this kind of crazy idea that consumer finance, consumer credit was, consumption, just sort of borrowing against the future to consume today, which is different from productive credit, in his view, which is what businesses did. Jeremy Bentham's In Defense of Usury was written in response to Adam Smith, and Bentham won the intellectual argument, but not the policy argument, as we see that people are still talking now about bringing back usury ceilings and that sort of thing. And so it's important to understand why Smith was wrong, because this kind of guides why consumers want to use consumer credit. It turns out, overwhelmingly, what consumers use credit for is productive purposes. And that there are good reasons, rational reasons, why consumers want to shift the timing of consumption for two reasons. First is just a life cycle idea, which is early in your life, you have a very high demand for credit and a low supply. When you graduate from college or whatever, you're probably illiquid, you're probably insolvent if you've got student loans, right? But think about what you have to do. You have to go out, you have to move to a new city, start a job, get a wardrobe, maybe get a car, get an apartment, get furniture, do all these sorts of things. And you're at a period of your life where you have the least access to credit and the highest demand for credit. And so what do? You borrow, right? And then you start getting on your feet. And the next thing you decide you're going to do is, get married. And then what's really fun then is you get to have kids, because everybody knows they're really cheap. Right? So you got to buy a house and maybe another car. But basically the idea here is early in your life you're a borrower. As you move into middle age, you become a lender, right? People don't think of putting your money in the bank as lending to the bank, but as John said, that's what it is. And then you retire at the end. We also see that it's productive in the sense of accelerating the timing of the purchase of certain goods. Student loans are obvious. It would be stupid to say save up so that then, save up for 20 years and then you can go to college and get a degree so that then you'll be more productive, right? Mortgages, houses, that sort of thing. And so this is the demand that drives credit. And so what we see then is as we go through time, so at the end of the 19th century, farmers move to the cities, immigrants come in, we first get the wage economy. It runs up against all these stupid old usury ceilings that we had in the past. And what do we see? Loan sharks proliferate. Consumers need access to credit to deal with living in the city and deal with the wage economy. And so what ends up happening is loan sharks step forward, illegal lenders step forward to fill the gap. The Russell Sage Foundation at the time, around the 1920s, starts lobbying for the Uniform Small Loan Law, which was designed to raise usury ceilings and essentially allow consumers to get access to credit in a competitive, transparent market. That worked great. We saw a great boom in the 20s, in teens and 20s in consumer finance. And then the Great Depression hit. Stop me if you've heard this story before. People decided, well, one of the reasons we had the Great Depression was consumers had too much access to credit. So what was the response that came out of the Great Depression? Ratchet down usury ceilings, and they even had these ideas that consumer credit should be like a public utility. And so they adopted, for example, the fourth edition of the Uniform Small Loan Law, created convenience or certificates of convenience and necessity before you could open a new small loan business. What happened? Consumers lost access to credit, especially lower class consumers. By the 1960s, the Senate was reporting, a Senate report said that loan sharking was the second largest revenue source of the mafia. The loan sharking market was estimated in 1970 to be $10 billion at that time, which is about $69 billion in today's money. To give you a sense, it's about twice the size of the entire payday loan market was what was estimated to be the loan sharking market in the 1970s. And so what we saw was consumers needed credit. And what was going on? We saw the great migration to the suburbs. Levittown was basically founded by credit, right? The mortgage, now you need a car, now you need furniture, all the modern appliances, right? And what we see is the migration to the suburbs in the post-war era was funded by consumer credit. Now, for middle class people, that was largely met by retailers. Why? Because retailers could evade usury ceilings simply by marking up the price of their goods to bury the cost of the money they were losing on the consumer finance and the goods. Lower income people, however, got hammered, right? So all of us remember Williams versus Walker Thomas, the famous case if you're a lawyer, right? What was going on there? It turns out Washington, D.C. literally had no small loan businesses in Washington, D.C. Why? Because Washington, D.C. had one of the strictest usury ceilings in the country. So what you saw was this development of this so-called ghetto finance system where low-income people, and especially inner city people, people, as I said, always buy things like furniture and things like that on credit, as she did, right? But what was it? You could only get it from somebody who could evade the usury ceilings by burying it in the price of their goods, right? And so basically, low-income people were in thrall to these shoddy lenders in the city who could basically tie the goods together. So what we saw was another wave of reformers 50 years after the first. In the 1970s, the National Commission on Consumer Finance is founded. They basically have one central thing, which is more competition and get rid of usury ceilings, right? The other thing that was going on is we saw a rise of a national economy at this time. In particular, department stores adopted the idea that department stores like Sears that had branches all throughout the country, right? They would have a centralized credit system in a lot of these stores. The other thing was we saw technological developments again, which is debt collection is a good example. The declining cost of long-distance phone calls made it more feasible to collect debts across state line, which then created problems for the old state and local-based system of regulation. So what do we see in the 70s? We see first a movement towards deregulation because of the problem of loan sharks and to try to increase access for lower income consumers. And we see this rise to the national level to deal with the increasing interstate nature of the product, right? That obviously leads us to today, 50 years later, right? 1920, 1970, 2020. Where are we today? We're in the world of the internet, right? We're in the world of digital, which is not local, which is not national. It's kind of nowhere, right? And that obviously gives us a sense of what we're looking at now. We're looking at fintech. We're looking at different ways that consumers engage in disclosures and consume disclosures. I'm almost done. And then, and what are we seeing again instead? We're seeing the same stupid ideas coming back. The Credit Card Act, Dodd-Frank, the Durbin Amendment, right? We've actually had a proposal 2 weeks ago by Josh Hawley to put interest rate ceilings on credit cards, right? I mean, it's insane. It's like, how many times do we have to learn this lesson over and over again? The lesson here, and I'll close with this, is the great F.A. Hayek in his Nobel lecture said, when you're thinking about how to do regulation, he said, policymakers should not try to shape the results as a craftsman shapes his handiwork, but to cultivate a growth by providing the appropriate environment and the manner in which a gardener does this for plants, right? The way we should be thinking about consumer finance, how do consumers use it, what is the technology, and let's allow that to flourish and allow the spontaneous evolution to take place. Thanks.
Thank you for this very interesting presentation. And before we open up the floor for question, any common reaction to each other's presentation?
I have a question for John.
And I have a question for Kate.
I mean, they're all interesting. I mean, the interesting question is, what are we trying to solve for? And one is financial crises, where you assume that crises are the challenge and that government intervention is only going to be what is necessary to avert the challenge. And that was the paradigm that I was operating in for a long time after 2008 and 2009. And yet I look more recently, and you alluded to this at the beginning of your talk. I mean, the Bank of England decided they can't allow pension funds to suffer losses on long-dated gilts. We saw not just an intervention into the corporate bond market, but an incredibly rapid intervention. I mean, things were scary in the spring of 2020, but the pace of intervention was huge. We've learned that Signature Bank was systemically important, such that the SRE should be invoked. And so it's not, I don't think I disagree with anything that you're saying. I mean, I think part of the point, which I think is huge, is if the Fed's going to allow money market mutual funds to effectively become narrow banks through the overnight reverse repo facility, why are they still pretending that the elasticity of the ease through which people can exit that gets created through narrow banks justifies not allowing these things to be explicitly chartered? So I don't think I disagree with anything that you are saying in terms of the importance of this model, but I'm curious over how much you think is actually going to solve with respect to the extent of moral hazard and expectation of government intervention.
Well, I think you're exactly right to ask, the one thing I challenge is, you didn't make the assertion, but just because a politician decides to do something doesn't mean that that was the right thing to do. And the good old framework that before you regulate, identify the externality, the public good, at least be forced to come up with some sort of argument about that is a good one. I don't, why can't holders of corporate bonds take mark-to-market losses? That does not seem to me like an externality of public good. So, some politicians decided or officials decided that was a terrible thing to happen. I think we're still allowed to challenge that. And just this answers both you and a little bit Jonathan. I was worried about Jonathan's vision that don't worry, innovation will get us around bad regulation, because there is an externality in financial regulation. The temptation to print money, temptation to have cheap run-prone financing, the run is an externality. There needs to be some I'm as good a card-carrying libertarian as anybody else, but this is a case where you need some regulation. And a lot of the innovation was to get around the regulations and figure out how to print money. The special purpose vehicle is just the classic example. Great financial innovation seems like, oh, wait a minute, we issue overnight debt to buy complex mortgage-backed securities. That's called a bank, except it doesn't have capital controls. That's an innovation, but it was an innovation around the regulation to print money, which is an externality because it ran. So there is an externality, but I favor being clear about what it is and not just taking, oh, we had to save the world, let's pat us on the back, one more river of money and we saved the world, and we have to get ready to do it all again, I think is a dangerous thing. Now, can I ask my question to Kate? Even though I'm hogging the stage. I thought what you said was fascinating, and specifically on sanctions. You called for a conversation, so I want to press you on what the answer to that conversation is. Because what strikes me is there's sanctions are sort of like antibiotics. They cure things, but then they cause resistance. And as the more we sanction, the more we create the incentive for people to find alternatives around sanctions. I'm sort of aware that China is building another system, not to undermine the dollar for everyday transactions, but so that when the day comes, they can buy and sell all they want, break glass in case of emergency. The more we sanction, the more they build that sort of thing. I'm worried about the Canadian truckers. We're debanking, we're sanctioning like there's no tomorrow. And that not only goes into civil liberties, but that it goes into building the antibiotic resistance. And you mentioned we're now sanctioning elites in other countries as well as countries themselves. Isn't that such a good idea? Should we be telling the Russian oligarchs no, or should we be telling them, take your money, bring it to the U.S., take it out of Russia? Maybe going on to sanctioning elites in other countries isn't such a great idea. So anyway, it doesn't seem like an obvious, oh, yes, just enforce the rules and make more rules question.
I mean, I think I completely agree with that. And that's the conversation I want us to be having, and I feel like we're not having. I mean, so what's really interesting to me right now is we're not having a conversation over normatively when should we be using these tools, when should we not be using these tools, and how much have they practically changed? I mean, like Fourth Amendment doctrine for lawyers, we know it's a mess, but when we originally said, the Bank Secrecy Act, which was the kind of origins of all of this, was totally fine because you don't have any expectation of privacy effectively in the information that your bank holds. By contrast, like cell phone locating data, that's so specific, you do have a protection. But it's a practical matter now. I live in New York. Every time I get on the subway, I'm using my credit card. So like the notion that there's like a huge difference for the amount of information that's available has really changed in a world of digital micropayments. So I mean, the whole area is, I really think actually a mess, and we're not having a healthy conversation. And then we're allowing this not only to go on with sanctions, but like cyber. I mean, I think there is a lot of conversations that just don't fit, for better or for worse, a market failure framework where you say, like, look, huge vulnerability that we have for national security purposes are all of the banks. I mean, the risk is not people trying to come in and like, find ways to get money. Like that's going to happen, but the banks are kind of like arming up against that. It's that we have an infrastructure that you could actually decapacitate in a really meaningful way. Like similarly with the GSEs, I mean, the Fannie and Freddie are the bigger issues. Like they're sitting in conservatorship. I don't know anybody who thinks that's optimal, but we're like so afraid of having the conversation. We're allowing these massively suboptimal status quo to continue without there being conversation, and then we're having another conversation about stability. And I agree, stability for us for the last 15 years. I like your proposal. I don't think we get away from it, but I would just love to see more of the conversation over like what should these other domains look like what is the right way to do them, because we're not having them, and it doesn't mean it's not happening. It just means for me it's happening in a really, really suboptimal way.
Yeah.
There's one thing that surprised me a little bit, John, what you were saying, and it was that all we need to do to get to essentially a world in which there's a better, more sane, financial institutions have saner balance sheets, less of mismatch between various characteristics of assets and liabilities, is to get out of the way. And I guess I think that, I guess my only concern is that in order for that to be right, we have to define getting out of the way really broadly. Like, as long as there's a positively sloped yield curve, and we're declaring that mid-size and small-size and big-size banks are too big to fail, then these traditional kinds of banks like SVB and others are going to be able to attract capital pretty easily. So it seems to me we're going to need. To get where we want, where I think you and I both agree we want to go, would require fairly radical change, not just getting out of the way. I was wondering if.
Thank you for letting me clarify that. No, there is an externality. The temptation to print money is strong. You can't just get out of the way. You need no regulation. You need effective regulation. What I wanted to emphasize is we don't have to have a big reform of the current system in sense of fix Citibank's balance sheet. Get out of the way and allow narrow deposit takers, equity finance bankers to emerge. But the equity finance bankers will have the same temptation. It's always fun to print money. It's always fun to take short-term run-prone financing. You need they need to be stopped from doing that. And the simple way is once you start doing that, fine. Welcome to the highly regulated sclerotic system if you're going to do that. But yes, you can't just get out of the way. You need to get out of the way of letting those emerge, but emerge subject to the guardrail. No, you shall not issue run-prone short-term financing.
It's sort of funny to me. Maybe you're right. I don't know. I'm thinking about what you were saying about, let's say, the Lehman Brothers short-term financing repo market of subprime mortgages and CDOs and the like. That the people who are buying these financial instruments, knowing that they're rolling over every day, and that the funds are being used to finance long-term assets, and that the house of cards will inevitably come tumbling down. It seems to me that there has to that seems to me just a standard case where sort of market discipline would solve the problem. That when the music stops, you allow the people who've been doing this financing to go broke.
You can tolerate individual runs. You can't tolerate systemic runs. So there is this problem of when the system goes broke, the run comes in. Ben Bernanke got a Nobel Prize, I think rightly, for pointing out that when all the institutions go broke, there's no one left with the infrastructure to make new loans. Yeah. And the government in charge is going to bail out ex post no matter what. So you got to fix the system ex ante so it doesn't happen. Somebody has to bear risk. Bearing risk is not a bad thing. Earning rewards for bearing risk is not a bad thing. But then you have to bear the risk. And our system is private gain in good times, public bearing of the risk in bad times. Right. And we have to get around the idea that somebody somewhere losing money is a systemic problem. No, you lose money in the bad times because you were making it in the good times. Just don't tear down the system with you.
Right.
I have a question for my colleagues on the panel. The first one's for Kathryn and John both. Kathryn, you talk about the Federal Home Loan Banks, which is good, but how many times do we have to have mortgage banking crises. I see Peter Wallison over here probably about to jump out of his seat. Right? How many times do we have to have our mortgage system destroy our financial system before we realize the 30-year fixed rate mortgage with an unlimited right to prepay is the most idiotic financial vehicle that's ever been invented? There's a reason why we're the only ones in the world who have it. I mean, you mentioned the first, during the Great Depression, we had the problem of balloon payments, and they conjured this thing out of the air, the 30-year fixed rate mortgage type idea in order to stretch out payments. The savings and loan crisis was caused by that, right? It created a problem during the 2008 financial crisis, everything with real estate. So we've got that on one hand, and we've got the Charlie Calamiris point about fragile by design, the entanglement, the purposeful entanglement of politics with the financial system in order to accomplish these social goals, and in particular housing finance type goals. And it just seems to me, we want to focus on one side of it, but until we have a more sensible mortgage arrangement, I think we're going to have these recurrent crises. So I'd just be interested in that. I mean, neither of you mentioned the Calamiris fragile by design hypothesis, or in your paper, but it seemed like it kind of hangs over both of them. And John, I had a question for you about the political risk type things. And, I would never suggest that academic political scientists might not actually know that much about politics, because they're experts, right? But it does turn out we do see political risk in the system. So when Obama, illegally diverted the TARP funds and, plundered the creditors at Chrysler and General Motors, we saw markets adjust, which is the empirical studies suggest that after that, a risk premium appeared for lending to companies. If you're going to be a creditor and you're going to lend to a company in a heavily unionized industry, new bond covenants emerged that basically created new protections against that sort of political risk of the government intervening to rearrange priorities in bankruptcy. That's what I'm just wondering is, I was reading this, it's like maybe markets just realized this was all just a sideshow. Right, the political scientists can wring their hands about all this, but in 2018, 2/3 of Democrats literally thought that the Russians had hacked into American computer systems to win the election for Donald Trump. Right, 2/3 of Democrats thought that they were hacking computer systems and adjusted the vote tallies. Right, so this idea of election denial and challenge and all that sort of stuff, maybe it's just all a sideshow. Maybe the alternative hypothesis is markets don't see this to be a serious problem of political uncertainty, and when they do, as with the auto bailouts, they actually respond.
No, I don't disagree with that at all. I do think that that they're going to be the market clearly registers consequences in terms of changes in prices and interest rates when the government does stupid things. I didn't in any way, shape, or form mean to suggest anything to the contrary. In fact, that was sort of my point, actually, is that the markets do respond, and they often anticipate things. We haven't. My basic point was we haven't suffered the kind of doomsday catastrophic consequences and kind of economic meltdown that one might think, given some of the incredible craziness of government intervention.
Okay, I want to respond to Todd, in part just to praise what you had said earlier. At this end of the table, I was focusing on financial regulation towards crises and runs because I only had 10 minutes. And what you point out is, of course, all the other financial regulation also exists, and a lot of it's really dumb. Mm-hmm. And I love the way we were charged to think about the future, and you brought us to the past, because the same bad ideas come up over and over again. And having a historical understanding of, I do inflation. Diocletian went after greed and the middlemen and so forth. And we're at it right all over again. But you're exactly right. There's a lot of sand in the gears in the rest of our financial system. The 30-year fixed, and also that it's not transferable. Right now we have a problem that people aren't willing to sell their houses because even though they need to move, They're good jobs across the country, but they got the 1% fixed rate mortgage. And among the other curiosities of it, it's you can refinance down, but you can't take it somewhere else. By the way, I'm a finance professor. I don't know any finance professor who can calculate when it's optimal to refinance a mortgage in the downward. It's a very complicated option pricing problem. Nobody I know, it's just ridiculous that it's bundled in there. And what's our mortgage system? Our mortgage system is not just this sort of 30-year fixed thing invented in the Depression, funneled into, almost all is now securitized by the federal government. So funneled into Fannie and Freddie, the taxpayer guarantee of all mortgages in the U.S. stays with us. I mean, it's something else that we promised we'd fix in the Dodd-Frank era and just kind of sits there and languishes. We go to conferences, everybody complains, nothing ever happens on it. And one of the effects of this is the lack of innovation. Actually, a 30-year fixed rate mortgage with a downward refinancing option, that's an interesting product. But we recently rehabbed our house. Do you know how many different light fixtures there are? My wife made me go look at light fixtures. I couldn't believe it. But relative to that, the number of mortgage products is actually fairly, suppose I want a 30-year fixed rate, but I wanted the right to transfer it to a new place. That's actually, 30-year fixed really helps you plan, that's a nice thing. But maybe I want to take that financial product with that interest rate risk exposure, but the right to move it to another town. Well, for a price, somebody should be offering me that. Yep. Nope, sorry, not available. Why? Because it's not on the list of things that Fannie and Freddie will securitize, and our entire mortgage market goes through what will be securitized by the U.S. taxpayer. Oh, sorry.
I was going to say, so I mean, I don't know if I'm not fully on board with making the 30-year amortizing mortgage the target of all of the problems. And I do think, I mean, John hit some of the other key points, that does allow some stability in terms of people's ability to access homes and then actually build up savings over time. If you look at 2007, 2008, it was the 2 and 28s and the 3 and 27s where you had these short-term fixed and then balloons. And we look at what's happening in Canada right now, and actually negative amortizing mortgages are everywhere because people wanted to have a fixed monthly rate. And how do you combine a fixed monthly rate with an adjustable rate mortgage? Is through negative amortization. And so it scares me actually right now to look at what's going on in Canada. I think the bigger challenge is, and this is where John was already getting, is it's not just that this product is available, it's that it's part of a much broader infrastructure where the government has done a whole variety of other things, some of which make sense, a lot of which don't make sense. In terms of how they all fit together. And so again, for me, that's just the conversation that we need to be having. And instead, we're all kind of looking the other way as this is what's dictating the entire shape of the mortgage market. And that is actually what has enabled Rocket to become the biggest issuer of mortgages, despite the fact that, going back to liquidity problems, they have no access to government-backed liquidity. And that turned out not to be an issue in 2020 because we had a huge shock to the economy that was accompanied by an increased demand for housing. But we cannot take for granted that that's what it's going to look like in the future. So I think there's a lot of things to talk about with housing. I don't know if I would make the 30-year amortizing mortgage the problem that we need to solve.
Perfect. So I think we have 20 more minutes for Q&A. Yeah, for questions. So if there's anybody in the audience that have a question, I have a general question for the speakers. As a European and American citizen, so Italian and American, I'm very interested in cross-border dynamics. And many of you mentioned tension with foreign nations, and Ambassador Gray, as an ambassador to the EU, care a lot about access to foreign markets and the importance of having stable relations. So one big question is in terms of the future of financial regulation, what do you think is going to be the role of cross-border coordination, cross-border dialogue, or are there possible mechanisms to access to markets? And the other question is that we're thinking about the future of financial regulation, and something that we have not discussed a lot is technology. And until Silicon Valley Bank and FTX, tech was going to disrupt the financial system, provide alternatives. So international organizations like BIS and FSB, they've been talking about the role of technology as supplemental approach to supervision and regulation of markets and financial institutions. So any thoughts on these two aspects?
When I hear the words coordination and similarly public-private partnership, my hair stands up. I like competition. Coordination is, often a byword for we all get together and screw the consumer and the taxpayer more effectively. As we see in the states, the U.S., regulatory competition tax competition between the states we like between the states, and I worry about too much coordination globally.
I was going to ask, so I agree with that, I guess, but I wanted to maybe the most successful example of international coordination in history, I guess, would be the Basel Capital Accords, right, which are truly international and seem to have real teeth. So,
and they're working like a charm, aren't they? I mean, too big to fail is all completely ended.
Well, I don't think. Well, I think we have to blame, I think we can blame Dodd-Frank for that. I don't know that we can blame. We could still have capital requirements. They would be and allow banks to fail. There's nothing in the capital requirements that stop a local regulator from putting a bank, allowing a bank to go out of business.
I just want much more capital requirements.
Okay, yeah.
I would say I would dish on this issue because I do think that there's a place. I mean, there are going to be spillover effects in other countries when you have bank failures. And I think there's reasons not to just have trust that other jurisdictions are going to get it right. So not for setting optimal regulation, but in terms of setting like a base floor, there was a place, I think, for Basel coming in. They've never done a perfect job with it. We can tweak with the different things. But I think having some degree of convergence over baseline for situations where there are cross-border spillovers are important. And going back to Paolo's questions, I'm worried about that, actually. I mean, I think there's been a sufficiently strong growing skepticism around kind of the perceptions of technocratic control. Some of that has been a really healthy debate, but I think some of it has the potential to undermine some of the international coordination. And I think there are issues where some degree of international coordination for me are useful. And I don't think we actually have a good answer for how we do it going forward.
I mean, the hard thing, and I'm kind of maybe more agnostic than I was letting on. In other words, so 2 quick points on this. One is, one could, and I've heard this pretty persuasive, that you could sort of blame failures like SVB on these capital accords, right? Like, why were they had money in the treasuries because they didn't have to have any capital under the Basel agreements to offset the money that the assets they had in these mortgages. And I guess the question, and I don't know the answer, is sort of the counterfactual, like we all agree, I think, that right, you and I, Kate, would agree with John Cochrane that we need capital requirements on banks. So the question is sort of the counterfactual, which is, in the absence of international coordination, what would bank capital requirements look like? And the received wisdom, and I'm not sure it's wrong, which leads me to kind of be in your camp, is that it would be sort of even worse. There'd be kind of a race to the bottom, and regulators would be kind of captured by banks and have kind of even weaker. But I don't know that that's right. It's just a conjecture.
A lot of the need for capital requirements is second best, given that we know we're going to bail them out. A lot of the fintech companies, which were clearly not going to get bailed out, they voluntarily issue a lot of capital. The word is issue, not hold, by the way. They voluntarily issue a lot of capital because no one's going to lend them money without a capital buffer. So it's really, it's big.
I'll say, if I could say a few words on both those points. The first is, we mentioned AML, and that's sort of one of the things that was striking to me when I was doing the CFPB task force. So we talked to all of the financial regulators. If any of you ever really tried to think about what the effect of AML laws are on financial inclusion, for example, right, which is for low-income people, especially people who might be from a country that they're perfectly innocent, right? But things like remittances, things like people are from certain countries, if they don't have a lot of money, the bank just doesn't want to deal with them. It's not worth the regulatory hassle. And what was kind of shocking to me is not a single financial regulator has ever seems to have seriously asked, what is the impact of our AML laws on financial inclusion and these sorts of things. Second thing I just sort of mentioned is on the technology, which is technology really is a thing here, right? I mean, the obvious example is credit scoring, but it really goes to information, which is Stiglitz won the Nobel Prize in part for pointing out that there's an information asymmetry with consumer finance. information is the way we get around that, right? And what we have now is this sort of double-edged sword, which is if we tried to create the consumer credit reporting system is a miracle when you think about it, right? It's a marvel that we have these robust systems that allow access to credit by ordinary people, which was always a problem. What's amazing about that, though, is somebody came up with the idea of our consumer reporting system today. There's no way it would ever be thought legal. What we're going to do is we're going to report without your permission to third parties your performance on debt, and then they'll use it in deciding whether to give you a finance, right? Because we have this weird idea about sort of information, that sort of thing. And so there's these benefits and big data in the novel underwriting things that fintechs use and that sort of thing.
Do they have a system like that in Europe, this sort of centralized? Because they have hyper concerns about privacy that
and I think it evolved there as well,
okay,
right?
yeah,
But not as robustly as here. Other countries don't. Yeah. But the other half of that, though, is there is a new threat that I forgot to mention, which is that there is now the ability to use information in this financial technology to control people, right? We saw this during the Obama administration with Operation Choke Point. We're seeing it today with debanking. We saw it, it was prompted by John observing the Canadian truckers, right, which is the use of the financial system to sort of weaponize it against political enemies and products and people that you don't like is a problem. It's going to become a bigger problem. I will cite again also a statistic. 2/3 of Democrats in this country agreed with Justin Trudeau when he froze the bank accounts of the Canadian truckers. So the use of the financial system as a political tool I think is a growing threat. Just think of it this way. Just think if they could have used it against Martin Luther King and the Southern Christian Leadership Conference to say, well, look, obviously you're a conspiracy to do what the truckers did, break the law and create a public nuisance, right? That's basically what the logic is. And today, the ability to use this control over the financial system to go at to kind of for political ends. And that's not even considering the possibility of central bank digital currency and the mischief that can be caused by that.
I want to just cheer that without saying it all over again, because that's like incredibly important. I also want to, John brought up Silicon Valley Bank, which I want to go back to just a little bit. It's a very instructive example. For one, they followed all the rules. The rules said you're allowed to put long-term treasuries in hold-to-maturity bucket, and you don't have to mark them to market. The problem with Silicon Valley Bank is a combination of lots of uninsured deposits and hold-to-maturity accounting on the assets, and there was no rule uniting those two. So they followed the rules. And in fact, this is the problem of a rule-based system. I'm not a lawyer, but I think there's a good case that they could have, if a regulator had said, you've got a horrible mismatch here, they said, get out of my office. I'm following all the rules. I'm allowed to use hold-to-maturity accounting on the assets. There's nothing wrong against uninsured deposits. I'm doing my patriotic duty to hold deposits for the American cause. Get out of my office. You have no right to object to this. It's a problem. So what do we have 100,000 rules. Oh, we'll add a new one. Sorry, you can't combine hold-to-maturity accounting and lots of uninsured deposits. Well, we already have 100,000 rules. Good luck with that approach. And another part of Silicon Valley Bank that really I think was revealing to me at the time. So we were inflation broke out for a year. Everybody knew the Fed was going to raise interest rates. The Fed knew the Fed was going to raise interest rates. We're just sitting, we're sitting on the tarmac waiting for air traffic control, and usually the pilot says, "Ladies and gentlemen, please fasten your seatbelts." For that whole year, the stress tests, where the regulatory half of the Fed asks banks what's going on, was asking banks, what happens to you if interest rates go down? What if we replay 2008? I mean, how could you not be asking every bank in the country, hey, interest rates are going to go up. You guys that have been riding the yield curve for about 25 years now, get ready. Nope. They were asking them, what if interest rates go down?
I just want to add one footnote to what you said.
Please.
The Silicon Valley Bank thing, which is kind of a little bit my point about Delaware law and state law. So you're absolutely right from the standpoint of federal banking regulation. Silicon Valley got to show inflated equity capital because of their ability to put the historical value of these bonds rather than their market value on their balance sheet. But if they had tried to pay a dividend or effectuate a share repurchase of their stock, they would be limited by state law, which makes the directors personally liable for making distributions when the bank is insolvent. And under state law, they'd have to look at market values. They couldn't look at historical values. So
There's some sensible rules, is what you're saying.
there's some, but not too many.
I was just going to close with, now we are in the situation that all deposits are insured.
Right.
Everybody expects, and
Despite Barney Frank famously saying, we've ended too big to fail. Right?
so that's the lesson that I took on the regulatory architecture. Is fun. If you can't get this one right after 15 years, heavens, we got to try something.
I think that you saw a hand up. Yeah.
Thank you. I had a question for Professor Zywicki regarding the stupid usury laws. And my question is, I guess, it's not just Adam Smith. I think every major religion has prohibited usury laws, and also I think most states, going back to colonial times, had usury laws. So I'm just curious: is this beyond Adam Smith? Has Western civilization and human history not understood consumer finance until when, and then what changed?
Well, most people still don't understand consumer finance, but I think there is a point there, which is the idea of, well, first the idea of economic progress in and of itself, the idea of investment that can be worth more in the future is actually a really hard concept to get around, right? In biblical times, it was 7 years of famine and 7 years of prosperity, right? It was just cyclical. And so you could eat your seed corn, but you didn't really invest for the future. But the second thing is there's just this weird sort of inability to understand and sort of micromanage other people in the way that they want to use credit. Like they said in the National Commission on Consumer Finance, we don't try to set the price of a hamburger. We don't set the price of a car, yet we're going to set the price of the loan you used to get the car. And now, as we know, you can just change the price of the car if you tie it to the loan. So I think there is a fundamental error here. It's repeated again and again for whatever reason. Every person thinks that everybody else uses consumer credit recklessly, but they use it responsibly. And so I think it's just an intellectual error that is very persistent in people's minds. But again and again and again comes back, and we have, unfortunately, it seems like we keep having to learn the lesson the hard way, that you can get rid of the supply of consumer credit, but you can't get rid of the demand. And there's always going to be entrepreneurs like Tony Soprano and Fat Tony Salerno who are going to
bring it in the Italian-American.
Yeah, right. Yeah, right.
Italian-American Heritage Month.
That's right. That's right.
I said they were entrepreneurs meeting consumer demand.
To add to what Todd says, for thousands of years also, it was taken virtually for granted that prices had to be fixed by the government. One of the main intellectual error is transfer income by screwing with prices. And we've been doing that for 2,000 years. And slowly but surely, thanks to Adam Smith, we figured out that price controls upper and lower to either protect producers or protect consumers are a bad idea. It's taken virtually for granted that you need governments to tell people what occupations they can be in. Guilds, licenses, all the rest of it. Gradually, starting in the 1700s, we learned that's a bad idea. So I think consumer usury laws are just one example of price. And people still jump to that every day. Got to stop the price of gas from going up, stop the price of houses from going up. Yeah, well, that does, and regulate who gets to do what business. That doesn't mean it's a good idea just because we've been trying for 2,000 years to get over this bad habit.
And there is some self-interest involved, which is restricting access by ordinary people to credit creates more credit availability for richer people. That's what the evidence shows historically. So.
Any other question? Yes, please.
So I have two questions, so you can pick and choose ones. The main one is for the whole panel. Nobody's talked about securities regulation. And I wondered if you have thoughts about. Sorry, can you use that? So my first question is, I haven't heard anybody talk about securities regulation. I wondered if you would have any thoughts about the future of securities regulation, or don't you see major problems in that area? And
Well, I definitely see major problems in the area. I mean,
John, let me get my second question
Oh,
out for
go
the
second.
other
Oh,
John.
okay. All right.
And because I don't want to lose my opportunity, could you help us define the capital structure for banks that you would prefer? You talked about equity financing. So maybe in baby talk for me, how are you going to define equity? And equity is a percent of, what percent and percent of what? But Professor Macey?
no, I'd love to hear.
Well, that's a short one. Keep it simple. So I like good old-fashioned common stock. You can get fancy with other stuff if you want. I'm for a sliding scale. So I like to look at the market value of your equity relative to the face value of your short-term debt. And as that number gets lower and lower, we're going to, expose you to more and more of the tender mercies of the Dodd-Frank Act.
What about going back to the good old days where we had double liability for bank shareholders? That was a way of capitalizing banks. I'm a nostalgic guy like that.
Yeah, there's a lot of that, and then a lot of sort of clawback from the executives thing. But I think just I like small amounts of risk widely spread and transparently held through prices. But let's get to securities regulation.
I just really go ahead.
If there are specifics that you have on your mind, certainly, if we're looking at the future of it, I'm a little worried about using securities regulation to advance political goals, whether you like those goals or not. The current effort to end ESG and especially climate financing to force that via securities regulation seems like even if you like the outcome, a dubious way of going about it. But if there are other specific issues you had in mind with securities regulation, I'm sure you'll get more outraged commentary.
The thing that outrages me about securities regulation is how regressive it is, right? That the structure of our securities regulation is that we've made it incredibly difficult to access the public capital markets. We've shrunk the number of public companies from 6,000 to about 4,000. We have a situation where if you're the Stanford endowment, or you have access to investments that are only available in private placements that the average investor can't access at all. That it seems to me that's it's exactly the story that Todd Zywicki was telling about cutting off credit, making credit more available to sort of rich people. I think that if I were to make a change in the structure of securities markets, it would be to democratize them more and allow greater widespread access to securities by the outside of the private placement context.
I proposed reform.
Good.
So given the fees that people like Stanford pay for their wonderful ability to access these things, it's not clear they're making a whole lot of money. One of my colleagues added up that Stanford's paying $800 million in fees for their wonderful investments. It's not clear they're coming out.
Fascinating. Really interesting. Yeah.
Oh, can I ask a question before we wrap?
Yes,
It's
I
actually,
think so. You have the
reference to
authority.
securities regulation. One trend that I've been keeping an eye on, and it's come up most recently in securities regulation, is the ways in which regulation today might depend on policy change in the future. The SEC's climate regulation policies, part of that is not just physical risk of floods from climate change, but what they call transition risk.
Yes.
Right, the risk that in the future policies might change radically, that could be destabilizing. But we just went through this experience with banks and inflation giving rise to moves on interest rates, which had real-world policies. So it's not hard to imagine bank regulation going forward, keeping an eye on policies that might be inflationary tomorrow and worrying about them today. And maybe the most controversial example of this was a few years ago. Former Fed President Bill Dudley had a column in Bloomberg where he said financial regulators today with an eye to systemic risk should maybe take action today to avoid what they see as disruptive political outcomes in future elections. So that's just 3 data points. But I do wonder how much going forward, financial regulation in the present moment might depend on regulators' views of policy changes in the future. That's kind of a ponderous question, I guess, to drop on the panel as we're running out of time, but your question made me think of it, and I'd love to hear people's thoughts.
I'll just have a quick comment on that, and I'll just, I wrote an essay recently for Heritage on restoring the rule of law in finance, and what your question brings to mind was, you may remember Sally Amarova, who was the first nominee to be control of the currency by Biden. And if you recall, what finally brought her down was that she was going to use, she basically said we should use the financial system to bankrupt the fossil fuels industry, right? And this is sort of the peril and the importance of the financial system, right? It now sits at the center of everything that happens in this economy and the economy around the world. There's a reason why the Obama administration called it Operation Choke Point, because they said the financial system, they were going to use the financial system to choke off the air that these guys need to breathe for these industries that they didn't like payday lending and that sort of thing. And this is a switch. This is the on-off switch in the center of all this. And just by tinkering around with how you weigh capital, transition risk, I laughed when he said it, because it's this absurd idea that you have to discount for, one regulatory aid body is saying you have to hold more reserve capital because these guys over here who are part of our own administration might do something crazy to fossil fuels, right, for example. And so you've got to hold more risk against fossil fuels. And this ability to use the financial system for this anti-democratic purpose of controlling energy, of controlling products and services, of controlling speech, of controlling access to firearms, that sort of thing. And it's all completely non-transparent, right? The financial system is the apotheosis of the regulatory state in that there's really no rules there. It's all regulation by raised eyebrow and that sort of thing. And this problem of, I think, the rule of law in this predictability question is a really big one in thinking about how we keep the financial system not only stable, but also useful and not just become a means of anti-democratic policymaking.
I'll take a different view, because this is the joy of being an academic. There's a big difference between where you actually have regulation coming in, and some of this gets to John's point over how bad the stress tests have become. I mean, one of the challenges is we took a tool that was meant to be initially information producing and forward-looking. Greg Hopper spent a lot of time on these issues. And then we hardwired it into capital regulation. And as soon as we came up with the stress capital buffer, which again was originally proposed by Tarullo, even though it was ultimately implemented under Corals, like we were going to make them really predictable, because you don't want capital regulation to vary a lot from year to year. So we're creating a mechanism through which we had something that was kind of forward-looking and experimental and meant to produce more information. And when we put it in a regulatory architecture that by its nature was going to make it less of that. And I actually would like to see like the stress test of what they originally could have been in a different way, of just a tool where you ask all kinds of different hypotheticals, whether it's about Taiwan, whether it's about climate, who knows what. But I think that there is a separate place for regulators kind of not in a heavy-handed, this is what's going to determine the amount of capital and liquidity you have to hold, but kind of like we want to have a horizontal view across this overall system of what's going to happen or what banks think might happen in the face of particular types of shocks. And I think we've kind of gotten away from like those types of tools of like, let's ask a whole variety of different hypotheticals and then come up with an understanding of, are financial institutions able to produce that information or not, which is going to tell us something? And are there suddenly things that we see when we're able to look not just institution by institution, but kind of horizontally across the entire regime that suggests like maybe we need to be thinking differently about whether it's a geopolitical risk or a policy risk or who knows what. So I mean, I think part of it is just like you have to have a wealth of different types of tools, and we've done too little in the like let's just produce information that actually could be really useful and ask some hard questions.
You point out an interesting feature of our regulatory architecture, that anytime you do things once, it becomes a tradition, and then it becomes enshrined. And not only is the nature of the stress test, but the actual question was going to be, for the next 100 years, what if 2008 happens again? And not just as an experimental, this thing happened to work once. I want to, I think, Todd.
Well, actually,
Sorry.
I've got to cut us off. I'm sorry that, and it's my fault that the panel went wrong, but I'll apologize to the next moderator. Please join me in thanking our first speaker. We'll take a break and we'll be back at 1:45.